Picture this. You are 43 years old. It is a Tuesday night. The kids are finally in bed, and you decide to do something you have been quietly avoiding for about 6 months. You log into your retirement account, stare at the number, and realize that the sum total of everything you have put away for the future after 2 decades of working is roughly the cost of a used Honda Accord. The worst part is that you make good money. You have never been irresponsible, and you do not blow money on stupid stuff. You did everything you were supposed to do, yet here you are in your 40s, staring at a retirement balance that looks like a car payment, and wondering where the years went. If that scenario makes your stomach drop, we are going to fix it today by covering every major mathematically backed money milestone you absolutely must hit in your 40s. My name is Pete, and I am here to tell you that your 40s are not a midlife crisis, but they are a window of opportunity, and windows eventually close. To understand these milestones, meet Dave. He is 43, makes $95,000 a year, and has a wife, 2 kids, a manageable mortgage, and 2 car payments. Dave has $87,000 sitting in a 401k that he has not looked at since he first enrolled. He is not broke, and he is not reckless, but he's just floating along doing okay, which is its own kind of financial problem. Milestone 1. You must know exactly where you stand and feel the uncomfortable weight of that reality. According to Fidelity, you should have 3 times your annual salary saved by age 40 and 6 times your salary saved by age 50. Based on Dave's $95,000 income, he should have $285,000 saved by 40, meaning his $87,000 balance puts him roughly $200,000 behind schedule. If he changes nothing, he will be nearly $500,000 behind the benchmark by the time he turns 50. To be fair to Dave, the median retirement account balance for Americans aged 35 to 44 is only around $60,000. In fact, 36% of non-retirees have absolutely zero retirement savings. Having something saved puts you ahead of a third of the country, but that only highlights how bad the overall situation really is. The math of compounding interest stops being patient right around your 40s. To reach $1 million by age 65, a 25-year-old needs to invest $381 a month, while a 40-year-old must invest $1,234 a month. That is an $853 monthly penalty simply for being 15 years late. Every single year you delay in your 40s costs you roughly $60,000 to $66,000 in lost future wealth for every $1,000 a month you invest. If Dave ignores this math, he reaches 67 with just $190,000 in savings. Using the standard 4% withdrawal rule, that generates about $7,600 a year plus roughly $24,000 from Social Security, leaving him with a retirement income of roughly $31,600 a year. Since the average retiree spends over $61,000 a year, Dave is facing a brutal math problem lived out one stressful month at a time. Your action step for Milestone 1 is to log in today, compare your balance to 3 times your current salary, and write down the gap, because that number is now your project for this decade. Milestone 2. Kill the right debt in the right order. People in their 40s currently carry an average credit card balance of around $9,100, which is the highest of any age bracket. Add in lingering student loans averaging $42,000 to $45,000 and auto loans averaging $28,500 per vehicle, and the debt load becomes staggering. The average person in their 40s is carrying over $115,000 in non-mortgage debt, which redirects money away from compounding investments to service the past. First in the hierarchy is credit card debt. If you carry $9,500 at 22% interest, paying that off is a guaranteed 22% return, which you cannot reliably beat in the stock market. Trying to invest aggressively while carrying high-interest credit card debt is like filling a bucket with a hole in the bottom. Second is car loans. Dave's 2 car payments cost him around $1,400 a month, flowing into assets that lose value every single day. If Dave invested that $1,400 per month at 8% returns, he would have roughly $1.09 million over 30 years. Third, if you are still carrying student loans in your 40s, circle a hard end date on the calendar to eliminate the psychological weight of open-ended debt. Milestone 3 is the task that 76% of you have not done: estate planning. Only 24% of Americans currently have a will, and the 35 to 54 age bracket is the largest group lacking any estate planning documents whatsoever. Without a will, your assets go to probate, a court-supervised process that can take between 6 months and 2 years to resolve and drain $15,000 to $40,000 in legal fees. Worse, a judge who has never met your children will decide who raises them. A basic estate plan costs between $1,000 and $2,500, taking less time to complete than researching a new TV. Crucially, you must check your beneficiary designations this week. Retirement accounts and life insurance pass directly to whoever is named on the form, completely bypassing your will. Milestone 4 requires immediate action: securing proper life insurance. About half of Americans in their 40s have no life insurance, and half of those who do are drastically underinsured. The standard recommendation is 10 to 12 times your annual income, meaning Dave needs between $950,000 and $1.14 million in coverage. His employer-provided policy of 1 times his salary will only cover his family for about 18 months before the money runs out. A $500,000 20-year term policy for a healthy 40-year-old male costs just $35 to $67 a month. Wait until you are 50, and that exact same policy costs 2 to 3 times more. Get term insurance, which is clean and cheap, and avoid policies that primarily build value for the salesperson selling them. Milestone 5 addresses the college versus retirement trap. With 4 years at a state school projected to run somewhere around $120,000 to $140,000, Dave is tempted to pause his 401k to save for his daughter's tuition. The golden rule is that retirement savings come before college savings, every time without exception. You can take out a loan for college, but there is no such thing as a retirement loan. Pausing retirement contributions for just 2 years in your 40s can cost over $100,000 in lost compounding wealth by retirement. Plus, 75% of undergraduates receive financial aid, and up to $35,000 in unused 529 funds can now roll directly into a Roth IRA. Milestone 6 is the mortgage question, and why the answer isn't what you think. Over 60% of American homeowners locked in mortgage rates below 4% during the pandemic. Investing $100,000 at an 8% return grows to $1.74 million over 30 years, while using that same money to pay off a 4% mortgage only saves you about $66,000 in interest. Paying off a low-rate mortgage early is a $1.67 million premium for the psychological comfort of having no bank payment. Furthermore, home equity is illiquid, meaning $200,000 trapped in your walls offers $0 in a sudden emergency unless you sell or take a loan. Milestone 7 is maximizing the limits and planning for the age 50 catch-up contribution. At age 50, the IRS allows you an extra $7,500 in 401k contributions, bringing your annual total to $31,000. Maxing out just that catch-up provision from 50 to 65 can generate an additional $730,000 for your retirement. Do not wait for 50 to arrive. Automate a 1% contribution increase today and schedule another for 6 months from now. Milestone 8 is checking your asset allocation because you might be losing to yourself. The old rule of subtracting your age from 100 puts a 40-year-old at 40% bonds, which cannot outrun the 46% purchasing power erosion of inflation over 25 years. Modern guidelines suggest targeting 70 to 80% equities for a 40-year-old. Ultimately, I want to leave you with 2 versions of Dave. The first Dave paused his investments, kept his car payments, ignored his estate plan, and ended up at 67 with $29,000 a year and a financial situation that terrifies him. The second Dave ran the uncomfortable numbers at 43, optimized his debt, protected his family, and reached 67 with $880,000 and the ultimate luxury: options. The difference between those 2 Daves is a series of specific decisions made in a specific window, so make them right now while the math still gives you a fighting chance. None of these milestones are exciting, and none of them will make a good Instagram post. You are not going to go viral for checking your beneficiary designations or bumping your 401k contribution by 1%. But in 25 years, when the second version of you is sitting across from the first version, the one who meant to but didn't, you'll know exactly which decisions made the difference. That window is your 40s, and it is open right now. Get to work, and I will see you next time here on Pete Invests.